Welcome back. If you have been with us for the previous 2 sessions, you know we have been dismantling the deceptively simple concept of price. We started by looking at the rigid mathematical models of neoclassical economics and traditional accounting. The idea that price is just where lines cross on a graph, or simply the sum of your costs plus a markup. Then, in part 2, we stepped into the shoes of the marketer, looking at how price is actually a signal, a tool for positioning a brand within a specific segment of a complex market. But today, for this third and final installment on strategy in the market, we are going underground. We are leaving the sales floor and the marketing department, and we are entering the engine room of strategic management accounting. Today is about the mechanics of costing, but not cost as a fixed burden that you just have to deal with. We are going to look at cost as a variable, something malleable, something you design, and something that spans far beyond the moment a product is sold. This is part 3, key costing and cost management techniques. Specifically, we are going to unpack 2 formidable tools, lifecycle costing and target costing. And finally, we will touch on the digital frontier of dynamic pricing. Let's begin with a fundamental shift in perspective. Most traditional accounting operates in snapshots. We look at a month, a quarter, or a fiscal year. We calculate what it costs to make a widget in January, and we compare it to the revenue in January. But does a product's life really begin and end in a single accounting period? Of course not. This brings us to our first major concept, lifecycle costing. The core idea here is straightforward but revolutionary in practice. When we calculate a product's cost and determine its price, we must consider every single cost incurred from the moment of conception to the moment of disposal. We are moving from a short-term snapshot to a long-term panoramic view. Now, in the literature, we see life cycle costing applied in 2 distinct ways. First, think of it from the buyer's perspective. This is asset management. Imagine you are buying a car. The sticker price is important, yes, but if you are thinking strategically, you are also calculating the interest on your loan, the fuel efficiency over 10 years, the insurance, the maintenance, and finally, what you can sell it for when you're done. That is the total life cycle cost. This isn't just for consumers, it is a critical element in public procurement. In the European Union, for example, authorities use this method to identify the most economically advantageous tender, looking beyond the cheapest upfront bid to find the option that saves energy and disposal costs over time. But for our purposes today, let's flip the lens to the seller's perspective. This is product costing. If you are a manufacturer, a product's life has 3 distinct phases. Phase 1 is pre-production. This is where you burn cash on research and development, market surveys, prototyping, and setting up supply chains. Phase 2 is production. This is the operational phase, making, distributing, and selling the thing. Traditional accounting loves this phase because it's easy to track. Phase 3 is disposal and decommissioning. This is the end of the line, the costs of recycling, waste management, or cleaning up. Here is why this matters for strategy. If you only look at the production phase, you might set a price that covers your manufacturing materials, but completely fails to recoup the millions you spent on R&D 5 years ago, or the millions you'll have to spend recycling the product 10 years from now. Lifecycle costing forces you to average those massive pre- and post-production costs over the total number of units you expect to sell. A perfect example of this is the outdoor apparel company Patagonia. They don't just price a jacket based on fabric and stitching, their business model embodies lifecycle costing. They invest heavily in the pre-production phase, researching regenerative organic cotton and developing recycled materials. And they invest in the post-production phase through their worn-wear program, where they repair and resell used gear. To a traditional accountant, a repair center looks like an expense. To a life cycle strategist, it's an investment in product longevity that justifies a premium price point. Now, let's move to the second pillar of today's discussion. If life cycle costing changes when we look at costs, this next technique changes how we determine them. It is called target costing. We discussed in part 1 how traditional firms use cost-plus pricing. They calculate what it costs to make something, add a profit margin, and then push that price onto the customer. That is a push strategy. Target costing is the exact opposite. It is a pull strategy. It was pioneered by Japanese companies like Toyota in the 1970s and 80s. The logic flows backwards. Step 1. You start from the market. With comprehensive market analyses, you determine exactly what price a customer is willing to pay for a specific product with specific functionalities. That is your target price. Step 2. With careful financial analysis, you decide what profit margin you need to satisfy your investors. That is your target profit. Step 3. You subtract the profit from the price. The number you are left with is your target cost. This is a profound psychological shift. The cost isn't a result of the design. The cost is an input into the design. You are telling your engineers, you must build a car that does X, Y, and Z, and you cannot spend a penny more than this amount to do it. But this isn't just about being cheap. It's about navigating what Cooper and Slagmulder call the survival zone. Imagine a triangle. The three corners are price, quality, and functionality. Every market has a survival zone defined by these 3 points. There is a maximum price the market will accept, there is a minimum level of quality they will tolerate, and there is a minimum set of functions they demand. If you miss any of these targets, you are out of the game. Target costing is the discipline of keeping the product inside that triangle while still hitting that strict cost target. This requires intense collaboration. We often visualize this as the target costing triangle, connecting the customer, the supplier, and the designer. It forces the firm to look outside its own walls. This is called inter-organizational target costing. You don't just squeeze your own factory, you work with suppliers to find creative ways to cut costs without killing quality. You use value engineering to strip out features that cost money but don't add value to the customer. We need to pause here and look at the darker side of this efficiency. We are talking about sustainability and ethics in this series, and target costing presents a paradox. On the one hand, it can drive green innovation. If the market demands energy efficiency, target costing makes that a hard requirement for the design team. But on the other hand, the relentless pressure to reduce costs can be dangerous. When a powerful global brand demands a lower target cost from a supplier in a developing nation, that pressure flows downhill. It can eventually land on the shoulders of the most vulnerable workers, leading to low wages, poor conditions, and in extreme cases, modern slavery. As the sociologist Michael Burawoy noted, anarchy in the market leads to despotism in the factory. Companies know this. Patagonia, for instance, claims that it adapts the target costing model. They still have cost targets, but they overlay them with responsible purchasing practices. They mandate fair payment terms and shared responsibility, effectively re-engineering the system to prevent that downward pressure from crushing the workforce. They are trying to hit the cost target without externalizing the social cost. Before we conclude, we must briefly acknowledge the modern evolution of pricing, dynamic pricing. If target costing is about the discipline of design, dynamic pricing is about the power of data. This is where algorithms adjust prices in real time based on demand, inventory, and competitor behavior. Think of Uber surge pricing or airline tickets. It is technologically enabled price discrimination. It is efficient, maximizing revenue by capturing the exact amount a customer is willing to pay at a specific moment. But it brings its own ethical headaches, questions of fairness, transparency, and whether customers feel they are being exploited. So let's synthesize what we have covered in this chapter on strategy in the market. In Part 1, we saw the neoclassical model treating the firm as a passive price taker, and the accounting model focusing on covering costs and the required return on investment. In Part 2, we saw the marketing model use price to carve out a psychological position in the consumer's mind. And in this episode, in Part 3, we saw how strategic management accounting, through lifecycle and target costing, mechanizes that ambition. It turns the market price into a design constraint, forcing the entire organization to align its costs with what the market value dictates. We have now thoroughly explored the market domain of strategy, but a strategy is only as good as the organization executing it. How do you get thousands of employees to act in alignment with these complex pricing and costing goals? That is the challenge of our next chapters. We will be moving from the market to the organizational hierarchy. We will explore how performance management, management control systems, and organizational resilience hold this entire structure together. Thank you for listening to this deep dive into strategic pricing. Join us next time as we step inside the hierarchy.